Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
BTST time, Ashwani Gujral and Mitesh Thakkar with us for that. Good going, Ashwani. You would reckon people should take positions home today or book them? And what about individual stocks?
I think PSU banks are starting out a fresh rally. So chances are that there could be more follow through, and you can see the resilience at lower levels where, the bears can't take the price lower beyond a point. And also, you're getting these gaps. So if you have to do something, it has to be today, or you'll have to enter, a gap up tomorrow. So that way, this sort of a momentum style market, it's not likely to give you a whole lot of dips as people have figured out today. So right now is a good time to get into Nifty, Bank Nifty, and then we'll take it from there tomorrow. As far as stocks are concerned, TVS Motors is a buy with a stop of 530, target of 546. CESC is a buy with a stop of 930, target of 965. And Reliance Industries is a buy with a stop of 1225, target of 1260.
Okay, so quite a few buy calls there on Ashwani's list. Lots and lots of stocks on the move. HCC has also been flying away today. It's only a 15 rupee stock, but anyway, traders are lapping it up. Let's get some more calls in then. Mitesh, what are you working with last half hour?
RBL Bank, I think, finally managed to get past this 580, 585 zone. So that's a buy with a stop at 579. Look for 616 as the target. And Nalco is a BTST. You were just discussing the stock. Keep a stop below 69. Look for a 72.5 kind of a target. And that's in the future side because I think the futures are trading on a rupee discount.
Okay, by the way, just pull out the intraday chart on JSW Steel. That's a stock which makes a big move normally in closing trades. And just see that move in trade right now. So metals have had a big move today, of course. JSW Steel right now moving to the high point of the day. Ashwani, you reckon today could be also a fresh start in metal names because we have seen both ferrous, non-ferrous, quite a bit of buying today.
See, JSW Steel was a strong stock even earlier. A lot of the other stocks are below their 200-day moving averages. So that way an excursion towards the 200-day moving average seems likely. Now, what kind of follow through these guys get higher levels, that remains to be seen. For example, Tata Steel's the 200 DMA is still 620. So it's a start, but these are not the strongest stocks. They may be turning, but whether they'll be able to touch previous highs, that remains to be seen.
By the way, on the Nifty, don't want to be a party pooper, but there's just a little minor sort of a dip that's come in. Couple of points here and there. At one point, we were almost touching a 90-point gain, and now that's about 80 odd points. Lever is kind of taking it a little easy today. It's one of the stocks. Anuj? I mean, I know this is nitpicking. I mean, what can you say? 10 points, 11 points, right? The chart has been so steady. So.
I know. I just wondering, Surabhi, it's like, it's just sometimes, you just don't get pleased, You had a big rally on Friday, then, almost a 80, 90 point rally.
And it's still holding 11,500.
10, not even 10 points. It's 8 or 10 points of the highest point. I think, hey, that's okay. So
okay.
That's perfect.
Take that. Okay, on that note, let's move on and take a look at what's on Nigel's radar. It's Monday. It is mid-cap mania. Nigel.
Well, the stock that we're talking about is Stylam. Remember, this company actually, they were at a recent conference and the turnout was rather large. So I was quite inquisitive to know what does the company do and why is the turnout so large? The market capitalization is around 650 crores. It has had a big run in the last year or so, and it's only around 10% away from its all-time highs. What does the company do? They're into laminates, the total capacity, taking into account the additional capacity that they put on in the last couple of years. It's nearly around 11 million sheets of laminates. So that's the company we're talking about. In terms of some of their brands as well, that should be up for you on the screen. They have various brands for cubicles, for laminates, for decorative, for industrial, as well as residential laminates. So those are some of the brands that the company does sell and the company does go under. But let's move on to the next sheet then. Importantly, the market size of the laminates business is nearly around 5,000 crores approximately. Exports are around 1,050 and domestic markets around 3,950. Now, Stylam basically caters to that 1,000 crores. That's the export market. If we look at the domestic market, this has been the play for the last couple of years. There's going to be a shift from unorganized to unorganized. And in fact, that's perfectly what's depicted, because there's a huge, unorganized market as well. But if you move on then, why did the stock come on my radar? The first quarter, the numbers look very, very good. The last 5 years, the CAGR growth has been quite good. In terms of the sales growth, it's nearly around 20%. Profitability is higher as well. And importantly, it seems like a bit of an export play. With the rupee at around 70 rupees odd, which are the companies that could potentially gain? Well, this is one of the companies. Let's take the first point. Quarter one, the numbers look good. Top line growth of around 40%. You had the margins that came in high at around 16%. And importantly, the profit number as well jumped up by nearly around 45%. That's point number one. Point number two is that, in fact, in the last few years, they've grown quite well, from around 185 crores all the way to around 340 crores. Though the last year, FY18 was not that great a year, because the operating profit went up marginally and the net profit was as flat as can be as well. But otherwise, it's been quite a good performer in the last 5 years or so. And the third point is the rupee depreciation. They stand to benefit out there because exports contribute nearly around 65% of its total sales. And yes, they have some imports in terms of raw material, but importantly, the exports will outweigh that, is the sense that I got from the management. So that's another important point as well. Well, if you look at the debt in the books had gone up because their capacity had close to have doubled. Now the debt in the last year has come down from around 185 crores approximately to around 117 crores. The debt to equity ratio as well did drop from around 2.5 to sub 1 times odd. How do they do that? Well, they got some fund infusion. Close to around 51 crores is the number that they got from this fund, that's Lighthouse Fund, in May 2017. So that entire 51 crores was used to pay back the debt. Not just that, they're talking about selling one IT park, but they have been talking about this for the last couple of years, nearly around 18 months approximately. Till now, it's not yet sold. The company estimates it at around 40 to around 50 crores. In this kind of a real estate scenario, we'll have to see whether they even get that. So that's basically their plan in terms of reducing their debt. But if you move on then, and you see what's the shareholding pattern, after diluting their equity, well, it's come down to around 53%. That's the promoter holding. Lighthouse, as I told you, they have nearly around 10% stake in the company. And importantly, a couple of large HNI investors out there, they as well have stake. You have Mr. Ronnie Screwvala in there. And also you have Sundaram Alternative Opportunities Fund as well, in terms of fund that hold stake in the company. But that's about the shareholding pattern. What about the valuations? Well, first quarter, they have done quite well. If they do 30 crores for the year, if you give it a multiple of around 20, ROC is approximately moving towards the 20% odd mark. So then it comes to around 600 crores. If they can scale up and they can do 50 crores, then in fact it comes to around 1,000 crores. As of now, as of the last year, they did only around 20 crores. Well, some key important points, the promoter holding is 53%, but such a large part of it is pledged. So that's something I don't like too much. Secondly, they haven't paid dividend in the last 8 years approximately. And finally, the revenue is looking so good, but the employee costs are coming in lower. How are they managing to doing that? So interesting stock. Stylam is the company that we're talking about. Back to you.
Okay, Nigel, thanks a lot for that. Standard disclaimer, not a stock recommendation. Now let's cut across to a big guest. Nisha Poddar is in conversation with Ajay Piramal, chairman of Piramal Group. Nisha.
Hello and welcome to the show. Today I am in conversation with the chairman of Piramal Enterprises and the chairman of Shriram Capital, Mr. Ajay Piramal. Mr. Piramal, so good to have you on CNBC TV18. First, let's take it to the big picture. You're an industry leader. We are at a time when there is heightened global tension when it comes to a trade war. We have seen rupee weakening for various reasons, and also as India, we are entering into an election year. As a corporate leader, how do you see corporate India poised for this?
When you look at the whole scenario now globally, there are trade wars, yes. But I think to some extent, India is not going to be as affected as the rest of the world. Our economy, our domestic economy is pretty robust. Almost 55% of our GDP is only domestic. And that is an advantage that we have. In this whole tension with the trade wars, the rupee has weakened. But it's not the rupee weak as much as the dollar has strengthened. And I think overall we should come out better in this, because with respect to all other emerging markets, I look at the Indian economy is stronger. And there is still a lot of interest in Indian economy. In fact, I see that after this crisis in July, if you look at the foreign portfolio investment is showing a positive after several months of showing a decline. So I'm not as worried as would make out to be, and I think overall we should be in a stronger position. The concern which I have would be really for the oil. We are, as you know, a big oil importer, and that's where with high oil prices, that's going to affect the inflation and the fiscal deficit. So to me, that is of a greater concern than the trade wars today.
Up and away, not much changing on the screen. L&T 7% higher. Tata Motors has had such a good session today, 4.5% up, even on such a beaten down stock. And of course, metals have led from the front. Let's not forget Reliance Industries. It's played its part with a solid 2.5% up move as well. Mayuresh Joshi of Angel Broking is joining in. Mayuresh, thoughts on a stock like Tata Motors? I mean, today the market strength is so much that even Tata Motors is finding takers, but it's been anything but a smooth ride for this stock. What would your advice be?
Oh, absolutely, Surbhi. I think all the issues surrounding the stock, first in terms of the capex plans announced, which had a lot of apprehensions in terms of how their cash flows will pan out over the next few quarters and years. Add to that the kind of import duties and the kind of destocking that we probably saw within the Chinese markets, that reflected on its volumes. And the third aspect, obviously, I think even in terms of the new platforms, what probably happens in terms of the US sales as well as the UK sales in terms of a hard landing, specifically in the aftermath of Brexit. So I think considering all these issues, you're probably expected to see some kind of consolidation at lower levels, which we probably witnessed for the stock. But for a substantial upgrade, I think volumes and the numbers will do the talking. So I think within the four-wheelers, Maruti probably still remains a preferred choice for the leadership position that it has, the kind of variants and the waiting lines, timelines for these variants as well, and the large expectations of the fixed cost absorption for its Gujarat plant actually playing out in a very positive leverage in terms of their P&L. So I think Maruti, if I have to pick and choose between Maruti and Tata Motors, Maruti remains our preferred pick within the four-wheeler space.
Anuj, you had cited Tata Motors today in the morning. Now, fundamental, I mean, volume numbers are not adding up, but what else were you looking at in the stock?
No, I think both on Friday and today, Surabhi, simple thing. On Friday, there was 500 crores of delivery buying. Look, everything is good at a price, right? And the market is going through that phase where the market wants to see. This just does not mean anything. Let me put it this way. What you're seeing right now is a powerful counter trend move. The stock went to 52-week low, had a recovery from there. After that, it crossed the 20-day moving average. Normally, you know, weak stocks, when they rally, they halt at 20 DMA. The fact that it just sliced to that meant that perhaps a move towards 50 and perhaps even 200-day moving average is possible. Does not change anything. But in the near term, in the medium term, because there were too many shorts in the system, the market was at all-time high and the stock was at 240, 250. So obviously, you know, you will find some takers, and that's playing out in Tata Motors. Perhaps, you know, bear market stocks also give you tradable rallies, just like, you know, bull market stocks give you tradable corrections. It's one of those moves which is playing out right now in Tata Motors.
It's been phenomenal nonetheless. Since we're on the subject, Mitesh, maybe I can get your views. I mean, 270, if this is some kind of a just a bear market rally in the stock, any next levels to track? Is there any point trying to do a trade maybe tomorrow, day after?
So we had a call, and we have a disclaimer here that we've had positions as well in the stock and booked at around 270, that being the first target. But I believe that this is a stronger counter trend rally than what we have seen before. So once it crosses 271, 272, I think look for 286 and then possibly even 310 as the target. So I think next 5-6 months should be quite good for Tata Motors, and it should be a good buy on declines kind of a trade. It's decline in the last leg only. It's declined from levels of 440 to as low as 240, and the 440 high was in January 18. And I think the entire that decline could be retraced by a part, and 310 looks like to be a logical target for the next 6 to 8 weeks.
Okay. Ashwani, just a thought on the fact that today you have so many old economy stocks doing well. Of course, right on top being Larsen and Toubro. So many capex driven stocks doing well. Interesting, right? Because we are at all-time high for the market.
So why is that interesting?
Because I want to know in terms of the cycle where we are right now, in terms of some of these stocks, the way they move.
Well, we keep hoping for capex to start at some point. Maybe that's what the stocks are also hoping. But obviously, things which haven't rallied, people are looking for value, etc. But these will be underperformers for most part till, capex starts going gangbusters. This Larsen rally, maybe another 5-6%. But finally, results have to happen. Capex on the ground has to happen. The odds of getting stuck here are really large because till the bank lending, etc., does not start, who's going to fund the capex? So these are, cute trades for the moment. I don't think there's a fresh bull market yet on these capex stocks.
Mayuresh, we just have about 2 minutes to go. So just very quickly, there's been quite a bit of buying on some pharma names today like Divi's and Cadila. Do you like any of these stocks?
So Divi's had a phenomenal move, Surbhi. The expectations broadly are laid around their CRAMS business, which obviously is lumpy, but the expectations of this growing at a very fast clip and the resolution of their plant will obviously reduce a lot of the remediation costs. So the kind of margins that the management is talking about normalizing to 35-36 odd percent, I think that will positively pay out on the earnings. Even in their core generics business, the kind of products that they've got, a couple of their products like Naxogen and a cough suppressant, I think they almost account for 70% of the market share. So to that extent, the generic growth in terms of top line should also be reasonable enough. So I think with a reasonable top line growth, margins about 35-36 odd percent, the company is reasonably poised to post an EPS around 50-51 odd rupees. So is there an upside to the stock even from the current level? There is, I think, a 10-12% upside still left. So I think the management commentary in terms of the remediation efforts and earnings growing at a very decent clip should hold out for the stock.
Okay, well, gentlemen, we've just got about a minute left before the day closes out. It's been a fantastic way to start the week in favor of the bulls, Anuj, and I guess not much complaints from today's action.
Oh, absolutely nothing. In fact, now now it's a bit of an issue of a running train. Will you get the other one, the next one, or do you want to, somehow jump into this one? I think that's a very tough call, frankly. But the fact that you opened at 11,500 and didn't see any profit taking, I think that says a lot about this market. Also, let's not forget a large part of this is global in nature. And today we have seen big stability in currency market as well. In fact, the rupee is almost up 0.6, 0.7%. That's a big move. Stock of the day, Larsen & Toubro, 7% higher on that stock. So big move on a big stock. Tata Motors up 5%, ONGC, Tata Steel, Vedanta, Hindalco. Metals did well today. Reliance, by the way, today hit a market cap of 7.8 lakh crores. So getting very close to 8 lakh crore market cap on Reliance. HDFC Twins bounced back, especially HDFC Limited. That was up about close to 2%. On the way down, not too many. Infosys, of course, was down 3%. It tried a recovery, but that recovery was sort of sold into a bit. Gale was a bit lower. Titan was down. But all in all, a good day as far as the large caps are concerned.
Well, mid-caps, pretty mixed trends. Largely speaking, it's been a good day. 150 points up on the mid-cap index itself. There have been quite a few high flyers on the infra side today, and these are actually, very small denomination stocks. So, HCC, GMR, GVK, these kind of stocks have had a field run today, particularly HCC, 20% up move on that stock. There's only 2 rupees, translates into absolute value. The other names from the infra side, Man Infra has had a 15% up move today. So, some interesting plays on the cyclical side of the market. Pharma names like Cadila and Divi's, we were just mentioning them, 5% to 6% up on both of those stocks. By the way, not just Tata Motors, the main shares, even the DVR has really surged today. Tata Motors DVR is up about 6%. And then you've also had stocks like Infibeam and Quality. So, it depends on which way you want to cut this. Very, very mixed trades coming through. Nalco surged after we got the management clarifying. There's a 10% increase in just a fortnight in alumina prices. The last tender that they've signed worked well for the stock. Good buying on Amara Raja. Good buying on Interglobe Aviation as well. 4% up on that stock today. And TVS Motors as well. That was a big mover of the day. TVS has managed about a 4% up move. Almost 5% at close. Can't ignore that. So big one going there. Canara Bank, OBC. These were some of the names. Let's pull up Bank of Baroda as well. Some of the PSU banks also found a little bit of traction in the market. This is where the gains really primarily were. I'll just quickly wrap up the tail enders as well. Thirumalai Chemicals, it had a good run last week. Today was a profit booking day, 6% down on that stock. Graphite India down. Then, of course, some of the Kerala exposed plays in the market, like a Federal Bank, like a South Indian Bank. That, of course, was a pressure point. Rain Industries can be kept in mind because this pet coke ban doesn't work very well for the company. So therefore, there was an impact that was playing out over there. That's about it. KPIT Tech, some of the high-flying stocks like Edelweiss, KPIT Tech, usually strong. They saw a bit of a cool-off, Marico, etc. Anyway, sitting close to 52-week high. So today there was a little bit of profit taking on them. But I guess, Anuj, all in all, even for the mid-cap market, not a bad day. Not
a bad day at all. Though advanced decline, you could argue a bit about that. But then, I mean, I think it's okay. But let's take final thoughts then from our experts. Ashwani, so what's the verdict for the day? And for those who have missed out this run, what's the advice tomorrow morning?
See, after a breakout, kind of had a big open and then you went flat. So tomorrow you could be vulnerable to somewhat of a bigger intraday dip. But the idea is simple that, try to buy on dips. So basically any sort of midday dip should be used to buy into. We had a large range day, you can say even today. So possibly tomorrow you are well placed for a sideways day, which means you open higher and then intraday you come off and again go back to the highs. So don't try to buy any sort of gap up because the odds of it working out for a third day in a row could be a little slim.
It's time for a very, very interesting conversation. A committee called the Committee on Real Sector Statistics presented its report late last week, and it basically gave the back series of GDP figures as per the new base year, that is 2010-11. This report showed that the average GDP growth from 2003 to 2013 was 8%, with actually double-digit growth being hit in 2 years. That's 2006-7 and 2010-11. Now, the series also shows that the growth under the 10 years of the UPA government was consistently higher than what we've seen under the NDA government. So let's bring in Lata, because she has a very special guest with her to take this conversation forward. Lata, over to you.
Yes, the data presented by this Real Sector Committee report clearly indicates that for 10 years, India grew at an average of 10%, and consistently there was no year where we had anything below 5%. I mean, it was not a year, a decade of wide divergences. And this 8% is in contrast to, something like 7.2, 7.3 average in the first 4 years of the NDA government. So that definitely is something which the UPA has been quick to jump to as one of its big achievements. To speak more about this report, I have with me Monte Ahluwalia, the Deputy Chairman of the Planning Commission under the UPA regime. Mr. Ahluwalia, thank you very much for joining us. First up, would you say that this is, at least in the first 5 years, largely good luck because the entire world grew from 2003 to 2008?
Well, I've heard that argument, but actually it is true that the entire world grew. But, the acceleration of the world economy was much less than the acceleration of the Indian economy. And when you take the period of growth, when I last looked at the numbers, I mean, the world economy may have grown about 0.7 percentage points faster. The Indian economy grew more than 2.6 percentage points faster. Okay. So it was a period of global boom, but I think the Indian growth recovery was much beyond the global boom.
Okay. Well, we'll take our point. The first 5 years clearly were, excellent years of growth. But, the second half, the second set of 5 years from 2008-9 to 2013-14, while many of the years we have, something like 7% growth, it falls to about 5.5 in 2012-13 and in 2013-14 to 6.4% GDP. Do you think that the second 5-year term of the UPA was guilty of artificially boosting growth through higher fiscal deficits, higher bank lending, and not recognizing the writing on the wall that was coming to us from the global growth story?
No, I think, let me put it differently. There's no question that UPA 1 showed a growth rate of, I think, 8.9% or something like that. Okay?
Yes.
Against that, UPA 2, the growth rate was 7.4. Now, remember that UPA 2 was also the period when you had the Eurozone crisis. So just as we say that, the global boom helped a little bit in the earlier years, the Eurozone crisis would have had a negative effect in the second period. Okay?
Yes, yes.
Even so, the growth rate in these new numbers in the second period, that is UPA 2,
yes,
is a growth rate of 7.4%.
Yes.
Now, I mean, the present regime, we don't have the numbers for the current year.
Yes.
But everybody has been using, even the official side, have been using numbers like 7.3%.
Yes.
If you end up with, say, 7.3% in the current year,
yep,
then the the NDA government's record in 5 years will be 7.2. So
yes.
in that sense, even UPA 2 will be better than NDA 2. The other thing,
I buy that
mentioned
average.
the last couple of years. Remember,
yes.
you said you forgot to mention, or rather you did mention, but you didn't highlight. The growth went down to 5.6, but then it started to recover. Now, the thing is, when you have a long boom, there's a tendency after a long boom to have a slowdown.
Yes.
And then the slowdown is usually used to correct some of the excesses that might have occurred during the boom.
Yes.
And some of this excess lending stuff, Raghuram Rajan had rung the bell in 2014.
Yes.
That there's a real problem.
Yes.
So I think if that had been corrected earlier, we would have had less difficulty now.
No, Mr. Ahluwalia, I take your point that, even after the dip in 2012-13, growth rate picks up in 13-14 and 14-15. I take your point on that. But just watch the other figures that have come from the real sector. And we didn't need the real sector report to tell us that. 2008-9, fiscal deficit, okay, it's a bad year. It's a year of the great financial crisis. Fiscal deficit jumps from 2.5% in the previous year
but,
to 6%. So let me finish. 6.5% the next year, 2009-10, not a crisis year. 4.8% in 2010-11, not a crisis year. 2011-12, 7% GDP growth, 5.9% fiscal deficit, not a crisis year. I mean, this is unforgivably high deficits.
Hold on. Let's step back.
Yes, sir.
First, the deficit going up in 2008, 2009 was a conscious reaction to the threat of a global recession. Okay? You can argue whether we should have done it or not done it. But believe me, at that time, when the whole world was teetering on the brink of a recession, when the heads of government of 20 countries had got together in October or something to create the G20 at the summit level, where everybody was saying we need fiscal stimulus and monetary stimulus, it would have been madness not to have a stimulus. So talking mindlessly about high deficit without recognizing that the high deficit is in response to a truly exceptional situation doesn't make sense. Now, secondly, you say the next year was not a crisis year. Listen, 2008, 2009, if you look at the global position, growth rate in 2008, 2009 was negative. I mean, when you get a crisis in September, Lehman Brothers collapses, the spread of contagion, the choking off of credit, the appreciation that you've got a serious problem, this took a couple of months. So the idea that 2009-10 was not a crisis, I don't buy that. It was a crisis. You can argue, legitimately I think, that maybe we should have tailed off the fiscal stimulus a little faster than we did. That's true.
Much faster, isn't it?
You can argue that. I mean, when you say much faster...
Sir, 5.9% in 11-12. That comes on the back of a previous year growth of 10.8%, and 11-12 itself, it's a 7% GDP. I mean, 5.9 is pretty unpardonable, isn't it?
Well, look, those are what happens to a fiscal deficit at any given time is essentially a judgment that the finance ministry has to make. In that particular case, what really happened was that there was a decline in revenues. And you have a difficult, you can have two different views. That is, when you're getting off the high deficit regime, how fast do you do it? I agree. Even the government then did try to get off it. What you're saying is they should have done it faster. On the whole, I agree with that. But, you know, you're now talking about the last 2 years.
Yes.
So when you're looking at the performance of a government which has been there for 10 years, and, you know, to my mind, yes, the last 2 years there were problems. Look, we said that ourselves, that there were problems.
Yes.
But take a government as a whole, it's a pretty damn good record. As a matter of fact, except for China during that period, that whole period, India was the fastest growing economy. And you know, in the immediate aftermath of the crisis, I mean, let me tell you that the IMF had done a report on India in the year 2009. Okay? And the IMF had said that, look, you've slowed down in 2008, 2009. We are projecting that you will slow down further in 2008, 2009. Actually, we recovered.
Yes.
So the question is, would it have been better to slow down further, or would it have been better to make sure that you can put the economy back on a recovery path? All said and done, I don't disagree with the view that the fiscal deficit should have been brought down faster. But, you know, to go on and on about the fiscal deficit without qualifying it by looking at the exceptional circumstances in which it increased is not, in my view, a very sensible way of doing it.
Well, Mr. Ahluwalia, sagacity lies in knowing when an extraordinary situation is confronting the country. And the UPA was a government of many intellectuals, many, you know, internationally renowned economists such as yourselves. So I wouldn't quite forgive not being able to see the writing on the wall for 3-4 years in a row. And mind you, the other point...
What do you mean? What do you mean 3-4 years? Where's the 3-4 years?
Yeah, 6%. I read out the fiscal deficit numbers to you. I read out the fiscal deficit numbers to you 5 years in a row.
Don't talk about the fiscal deficit numbers. Look at the objective global situation. The objective global situation is that in 2009, 2010, you've got negative growth. In 2010, 2011, the economy picks up a little. By the way, by then we are reducing the deficit. 2011, 12, you got a Eurozone crisis. I mean, Greece is exploding and so on. So quite frankly, I don't actually disagree that we should have got off the fiscal stimulus a little bit. But to say that for 4 years, a whole lot of economists missed everything, I mean, you know, hindsight is a wonderful thing.
Yes.
But please,
no, I agree with you. I agree with you. Hindsight is a wonderful thing. But, you know, on several years, the GVA is higher than the GDP, indicating that subsidies were very high and indirect tax collections were low. Now, that also is irresponsible, isn't it? Your GVA is higher than the GDP in at least 3 or 4 years.
No, because let me explain. First of all, GDP, I mean, GVA is a real measure of production and income.
Yes.
GDP at market prices is a different concept altogether. So when you say subsidies, you know, it is true, and this was really the problem of the fiscal deficit also. We didn't raise petroleum prices. Okay, I mean, I think I was saying at that time that we should. It's not easy to do. You know, the political system in our country does not make it easy to raise petroleum prices.
I agree.
But as a result, we had a sort of a hidden deficit, which was met by issuing oil bonds.
Correct.
If you ask, since I recommended it then, I would certainly say now, we should have raised petroleum prices.
Yes.
But
yes, you were handicapped. You were handicapped by the fact that the government depended on the CPM and on Mamata Banerjee's support, and she wouldn't allow you to raise. I take your point on that.
I don't want to point fingers at anyone because, you know, while some people are very loud, the truth is no politician wants to raise petroleum prices.
Okay. No, I accept that you all were very statesman-like in your last year, and you all did raise prices.
Let me just finish. We did start raising petroleum prices, which was a big change.
I agree.
You know,
I agree that it was very statesman-like in 2013-14 in the face of a general election to start raising prices. I give you credit for that. But now can you accept responsibility for something else? Because of this 4 or 5 years of continuous 6.6, 6%, 5.9, 4.8 fiscal deficit, you left the country behind with double-digit inflation continuously for 4 or 5 years. Is not that the UPA's fault?
I mean, look, inflation definitely did become too high. And, you know, if you, any government, when they look at a period, would look at what were the strengths and what were the weaknesses. And there's no question that inflation did become a problem. Part of the problem, frankly, is that our political class doesn't understand this. That, you know, if you don't jack up petroleum prices and you run a hidden fiscal deficit, all that happens is the general level of prices goes up.
Yes.
So we need a huge educational effort.
Yes.
Amongst the political class generally. I don't mean any one part.
Yes.
Generally.
Yep.
There isn't good appreciation of that, and every government will find that difficult.
Yeah. No, well, to be fair, both the UPA and the NDA have accepted the MPC. It started off in the UPA regime and it got legislative form under the NDA. So perhaps the responsibility of low and stable inflation has been accepted. But I want to come to another point that probably allowed the UPA to enjoy or give the country a 10% growth in 2011-12 and generally 7.4% growth in your second term. That was also because of what is very clear now, reckless bank lending. Should not that also have been a responsibility of both Mint Street and the government?
Well, look, there's no question that, you know, if you look at the history of any boom, you know, a boom usually consists of a genuine upswing, then a somewhat exaggerated, irrational exuberance.
Yes.
Every fellow thinks that he can go and invest. Bankers also become a little loose, and they feel that whatever happens, you can lend and projects will work. And then you get a bit of hit on the head, things start slowing down and you have to make a correction. So, you know, some of that is quite normal. In that sense, you know, frankly, when we appointed Raghuram Rajan in 2013, I mean, he did a terrific job. I mean, he highlighted this issue. And by 2014, it was very clear that this was a problem. Now, I'm not blaming any one government or not, but, you know, the truth of the matter is we're just talking about fixing some of these problems through the IBC, etc., which I think good initiatives.
Okay.
But, you know, I think there's a lot of blame that you can throw around everywhere when it comes to the banking, the failure to handle the banking crisis.
Yeah, it's a rather severe one, sir, and it is also getting into the taxpayers' pocket. So blame will not stop anytime soon, especially when large corporates default on their loans. But now, as you look at the past 10 years, especially the second term of the UPA, what are your lessons as an economist? I mean, wear your economist hat, not a UPA hat or an NDA hat. As an economist, are we wrong in aspiring or trying to get double-digit growth because the potential output appears to be more around 7%?
Well, let me say, I don't think any government formally ever targeted 10% growth. When we were preparing the 11th plan, we had actually said, look, let's try to go for 9% growth. At that time, we had already had 2 years of above 9%, and there was a great enthusiasm that maybe we can get 10%. But, you know, looking at the savings and investment numbers and all that, I mean, my judgment was that that's not credible, so we should be reasonable. Since then, the world has changed, the global situation has changed. I think today most people think that, you know, India probably can grow at 7+%. I mean, unless you make some big mistakes, you know, 7+% is possible. And I think most people feel that, you know, if we really get our act together, we could do better. Now,
but
how much
what
better?
Does that act together? What kind of reform does that entail?
Well, I think there are two separate issues there. One is the macro. You know, we need a much better understanding that what is a sensible macroeconomic policy. And frankly, to some extent, that is happening. Because today, there is a realization that the fiscal deficit has to be watched. The Monetary Policy Committee will look at the interest rates. And, you know, I think the next step really is fixing the banks.
Yes.
Right now, in my mind, to my mind, that is the single most important thing to get done.
Okay. So what would you say? So what would you say is the mantra in terms of numbers? What is good behavior in terms of numbers? Should we be very strict about a 3 to 3.5 fiscal deficit, 5% inflation, 2%, 2.5% current account, and most importantly, not more than 14-15% credit growth? Is that how we should look at it? What would be your big numbers that future governments should watch out for?
Well, I mean, I'm not looking at these numbers on any daily basis, but definitely if you just kind of trigger broad thoughts, I would certainly say that we ought to be targeting 8% growth. I think that's something we can do.
Yes.
You can always say, why not 9? But I say, let's get to 8 first.
No, I don't want 9. I thought 9 is what created the mischief.
Well, we didn't. We targeted 9, but remember, give us credit, we targeted 9 at a time when for 3 years the economy grew at 9.5.
Yes.
But we recognize that this is an unsustainable boom. So right now, I would say, by the way, I don't know what the target is because we stopped having targets.
Yes.
There is no, to my mind,
we stopped having a planning commission, yeah.
Well, I mean, the Niti Aayog could be doing it too, but they've said different things.
Yes.
At one stage, they talked about 8 to 10%. Then they said 8% plus. So I don't know what they're targeting, but we should be clear that the policies we're putting forth are based on certain targets. Now, as far as the current account deficit is concerned, my guess is that something a little above 2% is quite sustainable. We can finance it through long-term flows.
Yes.
For a very short time, if it went above 2%, maybe it can be financed. But anything more than that becomes a serious problem. And right now, it looks as if it's more than that.
Yes, so it's heading towards 2.7 to 3.
Yeah,
you would consider that a danger.
That is clearly a problem.
Oh, right.
Now, I think, the simplistic approach is cut down expenditure.
Yeah.
And the danger with cut down expenditure is that you cut down things like health and education and all the rest of it.
Yeah.
And you won't cut down untargeted subsidies. I mean, look, today, for example, the total fertilizer subsidy, most agricultural economists will tell you that if you get rid of the fertilizer subsidy and convert it into investment in agriculture, the country will be hugely better off.
Okay.
But is there a single politician willing to say that in Parliament? No. There are huge problems with agriculture that we need to address.
Yes.
But, we keep talking about credit, but then what we do is loan waivers. Now, if you're going to do loan waivers, you're going to kill the credit culture.
Mr. Ahluwalia, the king of all loan waivers happened in 2008, sir.
No, let me say, that was not the I wasn't in favor of it, by the way. And
fair enough.
That doesn't matter. You're right, it happened then. But that's not the first loan waiver.
Yeah.
Unfortunately, every 5 or 6 years, we seem to have had them. Now, what is really bad in the present situation is, fortunately, the central government isn't announcing loan waivers.
Yes.
But the state governments are happily announcing loan waivers. Now, question is, can they afford to pay for it?
No.
If they're not going to pay for it, is the central government going to bail them out? If they are going to pay for it, what are they going to cut?
Okay.
So, frankly, I don't think these things are no chief minister feels under any compulsion to answer this question. And I'm not referring to chief ministers of any one party.
Yes, sir.
In fact, the way the system is going, I'm sure most political advisors are advising chief ministers.
Yes.
They saw our loan waiver announced kar dijiye.
Okay.
And somehow or the other, it will be taken care of.
Yes.
I tell you, if the rest of the world, gets the impression that the states are going to drive us nuts, there'll be no credibility. The only test of fiscal credibility is if you let some states go bankrupt.
Oh, no.
In other words, if you don't bail them out.
Oh, right. Oh,
But
Mr. Ahluwalia.
Are we ready to do that?
Okay. No, well, I guess not. Mr. Ahluwalia, it was a pleasure speaking with you. Thank you very much for taking this call. It is very clear that great economists give much sounder advice when they are in the opposition and perhaps find their advice not taken when they give it when they are in power. Thank you very much, Mr. Ahluwalia, for joining us.
Well, Lata, thank you very much for that very, very interesting conversation. I'm just thinking we're still grappling with the idea of companies going to bankruptcy, let alone states of the country.
Actually, that's not fair of Mr. Alwala, because we ran out of time. I didn't want to fight. But it's actually the states are not reneging. States even don't pay their teachers, but they stick to their fiscal deficit. So
It's
this
the
is not a
center.
very fair comment. There are people who, you know, fudge accounts and make expenses, but this charge is not quite sticking. It's always the center which reneges on fiscal deficit.
Well,